Trump's 2026 tax bill could cost high-income retirees $100,000 plus. You will want to act now. A quick note before we continue. Ads may play during this video. Your support keeps this content free. Now let's jump in. Did you know that according to recent Congressional Budget Office projections, the 2026 tax landscape could trigger an effective wealth transfer of over $4.1 trillion, and high-income retirees are currently the primary target? Most individuals in their 60s and 70s are making a critical mistake. They are assuming that the permanent extension of the 2017 tax cuts is a universal win. But there is a hidden $100,000 trap buried in the fine print of the One Big Beautiful Bill that focuses on capital allocation and income phase-outs. If you have been diligent about building your net worth, you are no longer just fighting inflation. You are fighting a new era of institutional tax mandates. The reality is that if your modified adjusted gross income crosses specific, newly established thresholds, you do not just pay more in taxes. You lose access to the very write-offs designed to protect your liquidity. In fact, if you fail to rebalance your withdrawal strategy before the next filing cycle, you could be handing the IRS a six-figure portion of your legacy without even realizing it. We are entering a period of unprecedented fiscal shift driven by the full implementation of the One Big Beautiful Bill as we move into the 2026 tax year. This is not just another minor adjustment to the tax code. It is a fundamental rewriting of how the federal government views high net worth liquidity management. For years, the strategy was simple: defer as much as possible and manage your brackets. But as of January 2026, the IRS has introduced a series of cliff provisions. We are seeing a massive expansion in the standard deduction to $32,200 for married couples. But this comes with a trade-off. The legislation has introduced specific excise taxes and phase-outs for those utilizing high-value itemized deductions. If you are an investor or a business owner, you need to understand that the rules for asset-based lending and capital allocation have been optimized to benefit the government's deficit reduction targets. The cost of a single misstep in your capital allocation this year could easily exceed $100,000 over the next decade of your retirement. High-income retirees must act now because the window to shield your assets under the old safe harbor rules is officially closed. Let us look at a real-world example of how a high-income professional could lose $100,000 in value. Imagine a business owner in Texas who just sold a portion of their firm and is looking to retire with a $5 million portfolio. Under the previous regime, they might have relied on miscellaneous itemized deductions and a lower SALT cap. But under the new 2026 rules, their modified adjusted gross income, MAGI, now triggers a triple threat of phase-outs. The new $12,000 senior bonus disappears. Their SALT deduction is clawed back from $40,000 to $10,000, and they are hit with a 1% excise tax on certain physical remittance transactions. When you compound these losses over a 20-year retirement, the total cost to their estate exceeds $114,000 in lost purchasing power. This is the definition of a wealth trap. To navigate this, you need a framework based on institutional-grade capital allocation. The first principle is mastering the senior bonus deduction cliff. For the 2026 tax year, taxpayers age 65 and older qualify for a new $6,000 bonus deduction, or $12,000 for couples. While this sounds like a gift, it is actually a strategic pivot. This deduction begins to phase out at a MAGI of $75,000 for singles and $150,000 for joint filers. For every dollar you earn above these levels, the deduction is reduced by 6 cents. If you are a high earner with a MAGI of $250,000, this $12,000 write-off is completely gone. To protect this value, you must look at your retirement accounts. If you have a traditional 401k, your distributions count as income that triggers this phase-out. However, if you have properly allocated your capital into Roth accounts or used qualified charitable distributions, QCDs, starting at age 70 and a half, you can keep your MAGI low enough to secure the full $12,000 bonus year after year. The second principle involves the 2026 SALT cap management. The One Big Beautiful Bill has increased the state and local tax deduction cap to $40,400 for the 2026 tax year, but it includes a high earner clawback. If your income exceeds $500,000, the cap begins to revert back to the old $10,000 limit. This creates a massive marginal tax hurdle. If you are a high-income retiree in a state like California or New York, crossing that $500,000 line doesn't just put you in the 37% bracket. It effectively costs you $30,400 in lost deductions instantly. This is where liquidity management becomes vital. You should be looking at bunching your deductions or utilizing asset-based lending to fund your lifestyle without triggering the income that would blow your SALT cap. The third principle is the permanent 20% pass-through deduction for business owners. The Section 199A deduction, which was originally temporary, is now a permanent fixture of the U.S.-centric tax foundation. For 2026, the phase-in thresholds have been adjusted for inflation to $201,775 for singles and $403,550 for joint filers. If you are a retiree who still consults or owns a pass-through entity, this is your most powerful tool for wealth building. By ensuring your business income stays within these thresholds, you can effectively exempt 20% of your business earnings from federal tax. This is information the general public rarely acts on, but for a knowledgeable authority figure, it is the cornerstone of a six-figure tax savings plan. The fourth principle focuses on the new super catch-up contributions. Starting in 2026, individuals between the ages of 60 and 63 can contribute a super catch-up of $11,250 to their 401k or 403b plans, on top of the base $24,500 limit. This allows for a total contribution of $35,750. However, there is a catch. If you earned more than $145,000 in the prior year, the IRS now mandates that these catch-up contributions must be made to a Roth account. They are effectively forcing high earners to pay tax today in exchange for tax-free growth tomorrow. This is a massive change in how you should view your portfolio allocation. You are essentially being forced to buy into a Roth strategy, and if you do not account for this in your cash flow planning, you could find yourself with a significant liquidity crunch during your final working years. Finally, we have to talk about the 2026 estate tax exclusion. The new law has increased the basic exclusion amount to a staggering $15 million per individual, or $30 million for a married couple. This is an institutional-level opportunity to move massive amounts of wealth to the next generation tax-free. However, this high exclusion is currently scheduled to be a use-it-or-lose-it provision. If you have a high-value estate and you are not utilizing gifting strategies or irrevocable trusts now, you are risking a 40% tax hit on everything above the eventual lower threshold. This is how high-income retirees lose $100,000 or more. They wait for the perfect time to plan, only to find the window has slammed shut. Your first action step is to perform a 2026 Magi stress test. Look at your projected income from all sources, including Social Security, RMDs, and business income. Determine exactly how close you are to the $150,000 senior bonus phase-out and the $500,000 SALT clawback. The second step is to review your 401k contribution strategy. If you are in that 60 to 63 age bracket, you need to adjust your payroll withholdings to account for the mandatory Roth catch-ups. Third, for business owners, you must ensure your entity is structured to qualify for the permanent 199A deduction. This might mean adjusting your reasonable salary to maximize the 20% write-off. Finally, establish a multi-year Roth conversion schedule. The 2026 tax brackets are low by historical standards, and the 37% top rate is a bargain compared to where rates may go to address the $4.1 trillion deficit increase. To summarize, the 2026 tax bill is a double-edged sword. We have the new $12,000 senior bonus and the $40,400 SALT cap, but they are guarded by aggressive phase-outs that target high-income earners. We have the permanent 20% business deduction, but it requires precise income management. And we have the largest estate tax exclusion in history, but it is a temporary gift from the current administration. The key takeaway is that your capital allocation must be as dynamic as the law itself. By staying below the cliff thresholds, you aren't just saving pennies, you are preserving hundreds of thousands of dollars in lifetime wealth. If you found this institutional analysis valuable, and you want to stay ahead of the curve as fresh videos on this subject are uploaded regularly, please click the thumbs up button to give us a like as a thank you for this valuable content. It helps the algorithm share these strategies with other high net worth investors who are trying to navigate these changes. If you have questions about how the 199A deduction applies to your specific business, or if you have a strategy for staying under the Magi cliffs that has worked for you, please comment sharing an idea from the video content, or any questions or concerns you have. I read through the comments to see how you are all adapting to these new mandates. And of course, make sure to subscribe to the channel so as not to miss our next deep dive into the high-bid strategies that keep the wealthy in control of their capital. I am not your financial advisor. The information provided in this video is for educational and illustrative purposes only and does not constitute investment, legal, or tax advice. Every financial situation is unique, and tax laws are subject to change and individual interpretation. You should always seek professional advice from a qualified fiduciary, CPA, or tax attorney before making any significant financial decisions or implementing the strategies discussed today.